Hello, Andrew here. Welcome to my channel on investing. Recently, I asked myself a question: what are the best dividend ETFs that are worth investing in? If you are wondering the same question, this video is exactly for you. In this video, I will compare three most popular dividend ETFs, which are VIM, SCHD, and VIG. All three funds are top-notch, but they come with their own unique features that can cause differences across performance. My goal here is to identify and highlight these unique features. So let's get started. All three funds have the same expense ratio of 0.06% and comparable asset sizes. What's more, Morningstar rated these three funds with Gold Medalist rating. This rating is the highest rating based on the ability of a fund to outperform its peers over time. At the same time, these funds are not rated at 5 stars. I wouldn't worry a lot about them. This Morningstar rating is based on comparison of risk-adjusted returns over the last 3 years. So, in my opinion, the medalist rating is more important, while the star rating reflects a quick glance at a fund's recent performance. Next, let's take a look at how each fund constructs its portfolio. First is VIM, which tracks the performance of the FTSE High Dividend Yield Index. The index consists of highest yielding half of the large and mid-market cap dividend-paying stocks. The ranking is based on the projected 12-month yield. Firms that didn't pay dividends in the last 12 months or do not intend to have payouts in the next year are excluded. REITs are also not part of the index. The selected stocks are then weighted by their float-adjusted market cap. Because of the focus on yield, VIM has a somewhat high concentration in financial sector. All other sectors account for less than 13%. VIM's portfolio gravitates towards larger, more stable stocks. The total holdings number fluctuates between 400 and 500 stocks. The top 10 stocks account for about 26% of VIM's portfolio. Among them are large, solid names such as Broadcom, JP Morgan Chase, and ExxonMobil. Typically, focusing on yield can expose investors to value traps, which are companies with deteriorating financials and falling prices. But because VIM invests in a broad stock market basket and with market cap weighting, this risk is largely diversified. And let's say if the value trap starts to decline in its value, the fund will escort it out from its tracking. VIM reconstitutes its portfolio on a semi-annual basis with some breathing room for when a stock is dropped. This led to an incredibly low turnover of 9%, keeping a lid on VIM's trading costs. At the same time, this selection approach has delivered yields around 3%. This was about 1% higher compared to, say, Russell 1000 Value Index. Next is SCHD, which tracks the Dow Jones US Dividend 100 Index. SCHD's primary focus is the quality and sustainability of its dividends. Like VIM, SCHD takes a pool of potential stocks that excludes REITs. First, SCHD screens stocks with a dividend history of at least 10 years. After that, the fund ranks stocks based on dividend yield. The next step is crucial, and this is what sets SCHD apart from the other two. The fund ranks stocks based on free cash flow to debt ratio, return on equity, dividend yield, and a 5-year dividend growth rate. This process allows SCHD to identify stocks with wide economic moat, strong returns, and rock-solid balance sheets. Also, it allows the fund to withstand market downturns with smaller drawdowns. Next, CHD ranks stocks based on their market cap. Individual sectors can have no more than 25%. Currently, SCHD is overweight in financial, healthcare, and consumer defensive sectors. Each stock can have no more than 4% allocation. Briefly looking at the top 10 holdings, we see many large stable companies with strong balance sheets. These include Verizon, Chevron, and Lockheed Martin. Overall, there are 100 stocks in SCHD's portfolio. SCHD rebalances on a quarterly basis. Because of this, SCHD's turnover ratio stands at 28%, which is somewhat high compared to others. As for VIG, the fund tracks the S&P US Dividend Growers Index. VIG has a very strict requirement for stocks. They must have at least a 10-year history of growing dividends. That's right, not only paying but growing their dividends. This automatically excludes a large swath of companies that didn't increase dividends. For instance, only recently VIG included Apple and ExxonMobil in its portfolio, and this happened only after these two paid consistent and growing dividends since 2014. And if for any reason Apple misses a single dividend payment or decreases its dividends, it will have to wait another 10 years. Next, VIG ranks stocks by dividend yield and excludes companies that land in the top 25%. In other words, VIG passes on the highest yielding companies. The likely rationale for that is to avoid stocks that may cut their dividends or become value traps. This is a very unique filter that I personally see for the first time. With it, VIG wants companies that can not only afford increasing dividends, but are also willing to do so. The fund limits individual stock exposure to 4%, but has no sector limits. Overall, there are 315 stocks in VIG's portfolio. If we look at the fund's top 10 holdings, we see some pleasant surprises. Microsoft, Apple, Visa, and MasterCard are part of the portfolio. Some of these companies were excluded from SCHD and VIM because of low yields below 1%. This partly explains why VIG doesn't have a very high yield, which stands roughly at 1.8%. But the fund holds stocks that can give you a broad market performance and a slightly better yield compared to, let's say, S&P 500. And this could be a worthy compromise to someone. The fund is full of high-quality names that are capable of upping their dividends going forward. Also, this explains why VIG has a tilt towards tech as well as financials and healthcare. Tech sector exposures for SCHD and VIM were around 10%, which is small. Again, not surprising given how VIG selects its stocks. The next piece of the puzzle is the historical performance comparison. Because SCHD was started in 2011, we'll have only max of 10 years of comparison. Looking at 10-year horizon, we see that each fund was within roughly 1% deviation from each other. Of course, even a small difference such as 1% can compound into a big snowball over time. That is definitely something to keep in mind. What's interesting is that SCHD underperformed both VIM and VIG on a 1 and 3 year basis. Why is that? We can trace the likely reason behind this to how SCHD selects its stocks. Remember, SCHD filters its stocks based on various financial metrics such as free cash flow to debt ratio, return on equity, among other things. This automatically tilts SCHD to value. What's more, this tilt to value is even further amplified due to high concentrations at SCHD compared to VIM and VIG. It may seem surprising that even VIM outperformed SCHD, but it's not. VIM has a much lower stock concentrations and holds generally a larger number of stocks. And this partly explains why VIM has not only a lower yield compared to SCHD, but also a slightly better performance recently. Conversely, VIG is a completely different type of animal. It clearly has bigger tilt towards large-cap growth stocks, such as Microsoft, Visa, and MasterCard. While VIG doesn't have high yield, it makes up for that with its price appreciation. Its stellar performance in 2023 is a case at point. Comparing financial and valuation metrics for the three funds' portfolios, here's what we see. SCHD has a somewhat higher return on capital compared to VIM, and a slightly lower PE and price-to-sales ratio. So the defensive nature of CHG's portfolio is visible right away. When many growth companies performed well in 2023, heavy and concentrated tilt to value backfired on SCHG. Thus, there is a trade-off here to keep in mind. Value investing theme comes in and out of fashion. So, while today's performance suffered, SCHD may do well over long-term horizons. Let's look further at risk-adjusted returns or adjusted for volatility. If you watched my previous videos, you probably know that I don't see volatility as an objective measure of investment risk. Volatility is the proxy for risk used by modern portfolio theory out of convenience. Of course, volatility can be important for someone who is concerned with the timing of his sales. But the true definition of risk is the probability of a permanent loss of capital. If we compare Sharpe ratios and max drawdowns, we see that SCHD actually did pretty well on a 5 and 10-year basis. Of course, it lagged its peers by a large margin in the last year. We also see that the max drawdown for VIG was substantially larger. Again, this is not surprising given VIG's exposure to growth stocks. So what is the conclusion from all this? Is one fund better than the other? I'm not a big fan of definite answers when it comes to investing in ETFs. Investors' preferences vary, and so will the choice for the ETF. Instead, let's put it all together and go over cons and pros. The first feature is diversification. Both VIM and VIG are very well diversified at the top. They hold a large number of stocks and place limits on their individual allocations. Conversely, SCHD is more concentrated. Concentration is a double-edged sword. It amplifies both returns and losses. In my previous video, I covered why some other top-heavy ETFs are like stock picking and may need more in-depth study. But in the case of SCHD, I do not see it as a major concern, but rather as something to keep in mind. Next is investment style. Both VIM and SCHD have a tilt towards value, but CHD has a higher value tilt with above-mentioned concentration. VIG stands out by incorporating a mix of both value and growth stocks, landing it in a so-called blend category. This has many consequences, some of which we have just discussed. Higher value tilt may expose SCHD to perhaps lower returns when value goes out of fashion, but SCHD screens stocks for various key financial metrics. This saves it from getting stuck with value traps. Thus, SCHD seems to have a more defensive portfolio and may withstand drawdowns better. Conversely, VIG has a much lower yield. Instead, the fund relies on price appreciation to generate strong total returns. This makes VIG performance more volatile if that is a concern for you. The next point is sector exposure. Some investors may care where ETFs invest their money. VIG stands out with the highest concentration in tech. SCHD and VIM have a somewhat similar sector allocations, but SCHD doesn't have a high concentration in tech, but provides some exposure to utilities. Obviously, these allocations change with market conditions, so it's not like this is set in stone. Overall, VIM's strength is diversification. The fund will perform well under many market conditions, generating a sizable dividend yield for investors. Its tilt to value will give you a modest capital appreciation too, so maybe VIM could be a candidate as the best all-around dividend ETF. As for SCHD, it may appeal to investors seeking a slightly higher yield compared to VIM. The primary strength for SCHD is that it is much stricter when it comes to the choice of stocks. It has rigorous financial screens. By doing so, SCHD selects financially stable companies capable of paying and growing their dividends. But the fund is more concentrated at the top with fewer holdings. Given these features, SCHD is a great candidate to be the best dividend ETF for investors looking for a higher yield. And finally, VIG. The fund doesn't offer a high yield compared to SCHD and VIM, but it largely eliminates value traps from its portfolio through its selection process. Value traps are typically the biggest concern for yield-seeking investors. A high yield looks attractive at first sight, but it could signal a company with deteriorating financials and upcoming dividend cuts. VIG steers clear from these companies. Instead, the fund focuses on stocks that have a long history of growing dividends. By doing so, VIG built a portfolio that includes many dividend aristocrats. These companies can handle market downturns and offer a competitive yield. This makes VIG a great candidate for the best dividend ETF for yield-seeking investors, focusing on safety and higher capital appreciation. That is it for this video. I hope you found it useful and it will help you to choose the right dividend ETF for your portfolio. Please give this video a like and subscribe to my channel for more content about ETFs and investing generally. Thank you for watching.